So that is one is on valuation of future contracts. There are models where you can use, and also hedging tools and techniques in future contracts. Okay, so this also like gonna take a lot of time. The real data that we will take, and I will show like how you can take positions for of a short or long position in a different situation, so that you can hedge your portfolio. So now when it comes to valuation of future contracts, few models are proposed, and the models that just have listed here, where you can use this particular equation. See, any of the textbooks or even in the internet, that if you write it, then you are going to get this particular models. So it's the same models that I can use it here. If you want to predict the price, whatever the today's spot price, you take and predict the price by using any method. So these are the conventional methods which is available, and you can use either it is econometric models, or you can use artificial neural network model for a better predictor, and you can take a decision. So these models say, like, three cases that just are classified into three. One is that security providing no income. That means there are stocks which they don't pay any interest, any dividends, as well as there will be no any capital appreciation. Okay, that is in the yield. So such security, it is called as a security providing no income. How do you can calculate is that F, that is future value, is equal to S naught, that is the spot price, either it's a spot index or the stock price of any company, spot price, e to the power of RT. So if I use e to the power of RT is a future value, if I use e to the power of minus RT, it is a present value. So now I'm using e to the power of RT. That means that I'm going to calculate the future value of this particular spot price by assuming that risk-free rate of return, right? But when it comes to R, risk-free rate of should be continuously compounded. Okay, so that is the assumption in this particular models, where any this one, what is that rate, that interest rate that you are going to take, or the risk-free rate of return that you are going to get take, that will be continuously compounded. That is interest on interest over the period of time. This is number of days to maturity. How many days it's left for the maturity of that particular future contract? You're going to take it here and calculate what the future value. Then you take a decision whether to get into that such particular contract or not by comparing the predetermined price. Okay, the price which is prevailing in the future contract, by comparing this calculated future value with the predetermined price, or like the execution price, you can take a decision whether that you want to take a short position or a long position, either that you want to get into this particular future contract or not. We also have case 2, where the securities providing income. Most of the stocks which comes under this particular section, where the companies will pay the dividends. So if they pay the dividends at a certain period of time during this future contracts, okay, during this future contract tenure, then such the dividends you have to consider. But what dividends? It should be a present value of dividend. See that I will get into future contract today, where another 1 month is having a maturity. So in between this, the company have announced the dividends. Then I have to take that particular dividends. Then I have to calculate the dividend from the day when they announced and to the present value. Then you have to calculate the future value of such kind of stock or index. So same here, you can see the index is not going to come here, which usually it will be a stock. So here you can see I is equal to y e to the power of minus RT. Y is a dividend, e to the power of minus RT is a present value at a risk-free rate of return and the time that they're going to pay. Now we also have case 3, yield, okay, which is going to give some capital appreciation, the fixed yield. So here, how you are going to use is the S e to the power of R minus Y. That yield you are going to deduct it from R into T. Okay, the time to maturity. So these are the three cases where you can use it to calculate the future value, or the three models which is available. Going ahead, like I was telling that the interest rate, the risk-free rate of return must be a continuously compounded. So the concept goes like this, where the interest on interest will be paid. Then such particular interest, I can say the effective interest rate will be something which is called as the continuously compounded interest rate. So you can calculate like this: RC is equal to MLN, okay, natural log, okay, 1 plus RM, that is a risk-free rate of return, divided by M, or market return, I think is fine. M is how many times it's compounding in a year, either it is semi-annually, either it's quarterly, daily, how many times it is compounding in a year. So they say that this particular interest rate should be naturally log, okay. That means that movement of such particular interest rate from period to period should not be, say, like, first period it is 3%, second period it is 6%, third period it is 2%. That is not naturally log. It should be something like 3%, 3.5, say, like later it can reduce to 3.25, or maybe like it is going to increase to 3.75, so that you're going to get the normally distributed interest rate. Okay, so that's why that we are going to assuming this particular continuously compounded interest rate is naturally logged. So the explanation of this particular equation that I mentioned here: M is number of times compounding in a year, how many times it is compounding. RM is annual interest rate. LN is natural log, and RC is continuously compounded interest rate. RC, this is what that you have to use it for all the three methods that I've mentioned. I hope many people who will be teaching this subject, these models are familiar, but still, like, I felt like the basic models to be discussed, so that we can go to the further models, whatever is available, or situations, okay, where they're gonna, 1 second, I'm not getting the chat box. Okay, if any questions are there, please do speak, so that I will answer. I'm not able to put the chat box here, so if you write it in chat box, I will not be getting the question now. So annual compounding, if it is,
there are no questions in the chat box, sir.
okay, fine.
Yes, sir.
Yeah. So if it is a present value you are calculating, you should not use RC value. Okay, what you need to do here is that whatever the RC value you have, if in the question that they are given RC value, that is continuously compounded, you have to convert that into annual compounding, that is RM, and then you have to calculate the present value. Where you are going to calculate the present value? Here the I is equal to Y to the power of minus RT. In this place, where you have to use this R is annual compounding. Okay, so you have to convert that in, take it. Many authors say, many authors, they take continuously compounded here itself, but there is no logic of using a continuously compounded. Please do understand, because when you are discounting, it is not continuously discounting. I never heard the concept of something which is called as continuously discounting. It is simply a discounting at the rate is given. Okay, so that's why that I believe it must be at RM value only, that is annual compounding. So this is the equation, you can use it here also. M is equal to number of times it's compounding, RC is continuously compounded risk-free rate of return, and RM is interest rate, annual interest rate. So I've given this explanation here. So I'm taking one example here. Okay, so here it says that consider the 3-month future contract. That means just now that particular contract is started on Nifty 50. Assume that the spot value of index is 12841. This is for batch 1. I've used this. Okay, I will take the original spot price, so that the calculation, yeah, the spot price, you can see here Nifty 50, it is 13,487. So I'll write 13,487. 487. RF is 3.17. Where do I get is that simply that you can go to the treasury rate, okay, risk-free rate of return, right? Treasury rate in RBI. So yeah, you can see here 182 days, 91 day, or like call money. That means overnight, fortnightly you can use weighted average. So 91 days, 3 months. I can go for this particular rate. Okay. So I will take 2020 is 3.20. Simply you can click on this. You will also will get it here. You can see 91 day. The recent one is November 29th. Okay, this is 19. Okay, here November 27. It is 2.93. When I have taken the session for them, it was 3.14 or 3.17 that I have taken. Yeah, 3.17. So now it is 2.93. Okay, they say that whatever the rate is prevailing here, it should be naturally logged. You can also see it is naturally logged here because it is there in the variation of say like very less. It is not a huge variation you can see. I don't recommend you people to take 182 and 364 because these are long run in the stock market, right? So, but the contract is there only for a 3 months. So I have to go for 3 months treasury rate only. So 2.93. So I will take 2.93 here, which is the latest one, which is updated. So I will go here. It's 2.93. Yield on the security for the underlining. Okay, already I've given answer there. Okay. Yield on the security for the underlying index is 3% per annum. Okay, so this is something which is assumed. Find the value of future contract, assuming contract multiplier is 100. So which case that you are going to use for this? Anybody? Which case we can use for this?
So last example that you have given, last formula.
So I can say it is a case 3.
Yes, sir.
So case 3 is a right method, right one, because there is a yield, right? So I will write first given data. I will change the data here. One
So
is,
I have a small question.
yes, sir. Right.
Sir, for example, like yield that you have taken, so you have told us how to take in risk-free rate and the spot rate. So yield means what? Matlab, the return that the security is given, the historic return that you called yield in this case, or index
Okay.
return that you called it out. What exactly it is? I'm not getting it.
Okay, see this yield again, it is calculated based on the few factors of, like I was telling, capital appreciation. Okay,
Okay.
so
Okay.
you're going to predict this particular price using the method, the price, the difference between the spot price now and the future price calculated,
Yes,
the
sir.
rate at which it is increased, that is a yield rate here.
Okay. Okay. Yes, sir.
Okay, so again, it's a very big process of calculating this. So what I did that simply that I've assumed in or around
Okay.
this particular percentage only.
Okay.
So that's
Fine.
why like I've assumed it is 3% here.
Okay. Okay, sir.
So I may get negative here. No, it will be negative. So what I do that I will be reducing because for 3.17 I had taken 3. So I will take 2.8 percentage. Okay, I'll take 2.8 percentage. So if I calculate the RC, I think the font says okay. If I take RC, because they have not mentioned this particular RF is continuously compounded, so you need to convert that into continuously compounded. So this equation, you're going to calculate that it is 2.93 divided by 1. So if you calculate 0.293 divided by 1 plus 1, ln answer is equal to, so we're going to get 2.88 percentage. RC you're going to get it is 2.89 percentage, 89 percentage. Yeah, per annum. So maybe like, you know, if you have like I have a scientific calculator, you can do this easily, calculations, even manual calculation is also fine, but LN table value you have to take for the value that you are going to get here. So, but preferably the scientific calculator is going to help. So what I did here is I'm going to substitute that particular values. So that is 13,487 to the power of, this is 0.00289. It is not 00, sorry, 0.0289, that is 2.89 percentage, minus it is 0.028, which is a y. Okay, to the power of t is 3 by 12, that comes to 0.25. That I did not write here. If you want, I can also write this. 3 by 12 is quarter, so quarter I've taken. If I calculate that, 13,487, sorry, this is the calculated value, right? So it is 0.0289 minus 0.028 into 0.25. Shift E, answer is equal to into 13,487. So it is 13,490. See, 13,490 into 100. So I'm gonna get, it is,
So we can take a long position over here.
yeah,
Okay.
because the price is higher. So it is 4. Yeah. The future value of the lot size contract multiplier is 100 at the index value of 13,490. Sorry, 13,487 is the 13,49,000 rupees. Okay, so you can compare these two. The index which is given now, spot is 13,487, but the future value will be 13,490. So it is better to take a long position, so that you will purchase at 13,487 instead of 13,490 rupees. So that 3 rupees profit that you are going to get into 100 shares. So this is how the calculations can be done. So I have one more example here. That is a Nifty's, Infy stock is expected to pay a dividend of 2 rupees per share in 2 months. Okay. And again in fifth month. You can ask me, sir, the contract will be there for 3 months, but why you have taken 5th month also? Once the contract is maturing, there will be an option where you can roll out or roll over to the next contract, immediate contract. Okay, so you can continue that particular contract twice or up to 1 year. That means 4 times you can roll over to the next contract. Okay, in that case your contract will be continuing. So 5th month again they are paying. The Nifty Infy stock price is currently quoted at 1180 before. So I will take the same example. I'm because again calculations that I need to do. Infosys price is, it is 1164 now, or I can say the last day, yesterday's closing price. You can see here the open price is 11,168.05. So that was the closing price. So in that case I have to take here 1168. Okay, but still I have assumed that the closing price is on 1108 and the risk-free rate of return is 3.17. It's all assumption, compounded semi-annually. But yeah, so then what is the Infosys forward price for a 6-month contract, where the contract multiplier, the lot size is 1000 shares that you have to. Okay. So in that case, I'm going to calculate which case it is. Could anybody tell which case?
Second one.
Yeah, there is a income. There is a fixed amount
Yes,
of
sir.
income of 2 rupees in 2 months as well as 5th month. So now what I did, as it is compounded semi-annually, but it is not continuously. So I've converted that into continuously because here it is said compounded semi-annually, right? So that's why that I have taken m is equal to 2 and then again divided by 2 at the rate of 3.17 percentage. I'm going to get RC is equal to 3.15 percentage. Once
Sir,
after this, you have to
is there
calculate. Sorry.
is there any shortcut in Excel where we can convert? Is there any function in Excel where we can convert this continuously compounding into that?
I think
Is
so,
okay.
but I did not try.
Okay.
I did not try that. Maybe there is a shortcut. I have to find that. I will find
Okay.
out and
Okay.
then. Yeah.
Okay, sir.
So the first thing is that once you calculated the continuously compounded rate, then you have to calculate the present value of the dividend, where they are paying twice, that is on 2nd month and 5th month of 2 rupees each. So what I did is, see, I did not take continuously compounded rate here. If you take continuously compounded, it is wrong. You must take annual compounding, which of 3.17 percentage as it's given in the question. Then you have to calculate the present value. I have calculated the present value. One is on month 2, another that I'm going to get on 5th month. So I've calculated the present value, which I'm going to get 3.16. If I assume that the spot price of the Infosys is this, and I need to deduct the dividends paid, and I should use a continuously compounding when I'm calculating the future value. This is for 6 months. So the contract, they said it is for 6 months. You can see here for a contract 6 months. So 6 months. So when I calculate that, I'm going to get it is 1121.6, which the spot price is this. So what position that we are going to take in the future contract by seeing this particular trend? Any guesses? What is the position that we are going to
So
take it?
long position.
Yes. See, anytime if the price is increasing, simply that we have to take a long position, but it may go other way around as well. But we are assuming that they are paying the dividend and the risk-free rate of return is going to be this, and it is for 6 months. All this, and it is continuously compounded. It's not necessary it will be continuously compounded. By assuming all these things, we have calculated, and it is more than the rate. So we are going to take a long position in this particular future contract. But if you fear that the prices will fall in the future, in that case, I'm going to take a short position. I have one more example. I think I'm going a little faster because if the calculations were there, would have taken some time here. Anyway, like last time, this time also that I will take you through the commodity futures also. Okay, so that is not in the scope of the today's discussion, but still some glimpse that I'm going to give about that. Okay, so I consider a forward contract on a non-dividend paying stock. So that means dividend are not paid. ACC Limited stock, which is currently available of for 1508, will mature in 3 months' time if the risk-free rate of interest is 3.32% per annum, continuously compounded. So already they have given it is continuously compounded. Find out the future price of the forward contract. So definitely that I should use a case 1 here. First thing that I will take a given data. S0 is of the ACC Limited is 1508 rupees, and here whatever the risk-free rate of is given is nothing but it's RC, because they have mentioned it's continuously compounded 3.32, and it is going to mature in 3 months, that is 3 by 12. I will use this S0 e to the power of RT equation, and I will calculate the future value is 1520.5 57. So in this case also that feasible to go for a long position. So this is how you can use these particular models and calculate the future value. But the question is, yeah, so till now that I was telling about only the long position, taking a long position. If the price moves, then you are going to take a long position to take the advantage.
Sir,
But
I have a doubt, a simple observation. So,
yes, sir.
the formula that we have seen, all of the three formulas, it is going to multiply by the spot price.
Correct.
So in any condition, will be getting the price which will be more than spot price.
True.
What I
Correct.
assume.
Yes.
So in every position, I will be taking a long position.
But the
Is it
market
so?
sentiment will be
Yeah.
different, no, sir?
Yeah. The market sentiment I understand, but the
Mhm.
formula always will be giving you the number which will be the greater than the spot price.
True, because we are calculating the future value.
Exactly. So then we have to consider the market dynamics also and the
Yes.
consideration of this. This will give you a rough picture, but not an rough estimation. Okay, this will be the price and it can go.
Yes. Yes. So
Okay.
depending upon the market sentiment, only that you have to take a decision what position that you are going to take. So that's why
Exactly.
any model which is introduced, either it is for the future or either it is for the options or whatever the models are there, if you see the current market situation, so applicability of such models is less. But
Yes.
still, but these models widely used over the period of time, and
Mm.
by taking this, okay, this will be the future price. But if the, because seeing the condition of the COVID or like, you know, the situation, market situation, if it goes
Mm.
other way around, then you have to take a bold call of getting into the another position.
Exactly.
So that
Yeah.
is how the traders will be making the profits. If they don't do, simply if they do see these particular models and go ahead, then
Mm.
obviously they will be incurring the losses.
Exactly. Okay, sir.
But I'm
Thank
not
you. Thank
telling
you.
that this particular model will not help. But if it
Mhm.
is, the market is bullish in the sentiment, of course,
Mhm.
this particular model is going to be a perfect predictor.
Work it out. Okay, sir. Thank you.
Right. Yes, sir. So now let's understand, like, you know, few hedging tools and techniques or some principles. I mean, underlining this particular valuation of future contracts. So till now that we have seen only long position, because we know that we are calculating the future value always will be more than the present value. But there is a market sentiment. So depending upon that you have to take a different positions. What are the other different positions are? One is the short hedge. Usually what happens that we fear that if the price falls, that is the Indian traders market sentiment. I mean, like, you know, thinking. They think that, like, you know, getting into the stock market is highly risky because the prices will fall, then we cannot make money. So if such kind of like, you know, sentiment that we have, a fear that we have, then you have to take a short position in the future contract. If you take a short position in the future contract, such technique is called as short hedging. That means, what is the short position in future contract is, without holding a stock in your hand. Say for example that you have not purchased the shares of any company, you do not have in your portfolio, but still you can get into the short position in future contract, a selling position in the future contract. So this is something which is called as, in options also it is said, it is a naked call or naked contract. That means that you do not have stocks in your hand, but still that you will get into the short position. Okay, so you can also say that it's a short selling. Okay, where at the end of the day that you have to buy back that in a short selling. But in this, in future contract, it's not short selling, it's a short hedge. That means you are taking a selling position in the future contract. Simple. That this particular position that you are taking only when you are bearish in the sentiment, that means the prices is going to fall in the future, then only that we will hedge by taking this particular short position in the future contract. Then long position that we have been discussing, that sentiment that the prices goes up in the future. So you can take a long position of buying at the price which is decided by today. Say like the Infosys price is 1,164 today. I expect that the price goes up in the future. So I will take a long position of buying at 1,164 rupees in the future as well. So in that case, whatever the future price and the price at which that I'm purchasing, that will be the profits that the long position holder will be taking here. That is something which is called as a long position. Then we have cross hedging also. See, usually cross hedging is something which is hedging with unrelated stocks or unrelated assets, okay, industries. Say for example that I'm holding some stock of banks. Due to this, during this particular COVID, or instead of bank, you can take an example of any manufacturing company. Due to this particular COVID duration, there was manufacturing has completely had stopped, the production has stopped, and sales has been stopped. So in that case, the prices will fall. We know that the prices will fall. I will hedge with any other industry, some other industry stocks. Say for example, banks, or take an example of some IT, because IT was functioning, they were working from home. There was a transaction, maybe like Amazon was the best example if you take. So Amazon was working and they made a lot of money during this particular COVID-19. So where you would have hedged with the IT company, so that any losses that you're supposed to incur in this particular manufacturing units or stocks of manufacturing, you can offset that with the other industry future contracts. So if you do this kind of a adjustment, or I can say hedging, such hedging is called as cross hedging. Or take an example of airline and fuel, both are two different oil industry, both are two different industries, where if you hedge it, we know that it's both are related, so you can go ahead of hedging that as well. Now, basis risk. One of the technique that you have to understand is the basis risk. What is this basis risk? Is the difference between the spot price of an asset at the maturity. Please do understand, the spot price of an asset at the maturity and the future price of an asset. This price is fixed. The future price of an asset is fixed today only, that we have fixed the price and we are getting into the contract. Then the spot price, when that maturity is going to come, the spot price, the difference between that will be the basis risk. I give an example here as well. If the trader takes long position, that means buying position in the future contract, spot price at the time of maturity is 105, but the future price which we locked, that is predetermined price, is 120. For the long position holder, the basis risk is 15 points. So because if he was not taking this future price or future contract, he would have purchased at 105, right? But here that he is going to buy at 120 rupees, which is more than the spot price. Okay, it is not necessary always the future price should be less for the long position holder. It may go other way around also. The basis risk for the long position holder is 15 points. So here, just I wanted to make one point is, usually, okay, most of the time, even there is a lot of research on convergence. Okay, the spot price at the time of maturity almost converge to the future price of an asset. Okay, that means more or less it will be equal at the time of maturity. That's why, like most of the traders, they don't hold the contract up to the maturity. If they hold the contract up to the maturity, then they will not be having a profit or losses. Okay, so it will be at equilibrium, because there is a research evidence that the spot price will converge the future price of an asset at the time of maturity. Okay, so a lot of research has been done. There is a lot of analysis also will be done on this. Say like they have used co-integration and all this analysis. and also it is proved. Okay, but there is also possibility that this particular price also will be different, because that convergence will not be happening in all the industries or in all the future contracts. There is a chances that there will be some difference. If you find any difference between the spot price at the time of maturity and the future price of an asset, such differences is called as a basis risk. Is there any clarification is required on this basis risk? Okay, so I will move on. And I have one more thing, something which is hedge ratio. Now we have seen about, I've understood like I should go for a short hedging, I should go for a long hedging, I should go for a hedge, cross hedging. But how much that I should hedge in my portfolio? That is a big question. That if I have a portfolio of say like 1 lakh, is that full 1 lakh rupees that I have to hedge? So deciding upon that, where this particular hedge ratio will be helping, what is the percentage of your portfolio that you have to hedge in your in your portfolio? That will be helped, that will be explained in this particular hedge ratio. That simply can be calculated like this. Okay, Rx into standard deviation of spot price and standard deviation of future price. So here the hedge ratio, H star is hedge ratio, Rx is coefficient correlation between spot price and the future price. Either that you are going to take returns or price, it's one and the same. And STDT, standard deviation of S is the spot price, standard deviation of F is the future price. And coefficient of correlation you can calculate like this with this equation as well. Okay, what is there next? Yeah, this is something which is very, very important. One, I understood that what is the percentage of my portfolio I have to hedge. Next one, how many number of contracts that I need to hedge? That question should be taken. So when I've decided that 25% of my portfolio to be hedged, now that particular 25% is 25,000 rupees. How many future contracts that I have to hedge will be explained through this optimal number of contracts to short to hedge. See, the reason why specifically that I have written here short to hedge is existing portfolio I would like to hedge. Okay, existing portfolio I would like to hedge, that is 25%. I've assumed that here I got 25%. Yeah, here I got 25%. Hedge ratio is 25%. Assuming 1 lakh rupees is my portfolio, 25,000 that I need to hedge. So I'm holding that particular 25,000 stocks in my hand in my portfolio. So when I'm holding, that means it's a long position. That means I've purchased it. I fear that the prices will fall in the future. Then I have to take a short position in the future contract. But how many number of contracts? Such contracts, number of contracts will be explained this particular equation. That is, I have a hedge of my total portfolio, and each number of portfolio. Say for example that if I have 1,500 units in my portfolio, they said out of this NA is, I can see here size of position being hedged. So that means that I'm holding this particular number of units in my portfolio, out of which 25% that I want to hedge. But QF is how many number of contracts the size of one future contract, size of one future contract. So that by taking this particular value, I'm gonna get this n star. That means that it's an optimal number of future contracts. So now practically let's get into this. This is the answer that which I got for the previous batch. I ignore this because we are going to get a new answer. What I'm going to do here is collect Nifty 50 future contract data for 1 month. Okay, this date also that I'm going to change. 26 expiry. Okay, this month last day expiry. Just I will check NSE. Yeah. Nifty 50. Equity derivatives Nifty 50. Why I'm not getting? One second. Yeah. See, if I go to index, I'm just taking an example of index, not any company future contract, index future contract Nifty. I will go to Nifty only, Nifty 50. And 31st December is the expiry. You can see the nearest month I will take 31st December. Or you can also take this, or you can take this. I will just explain how many days of a price you may get. Say, for example, for 31st December, which is going to expire in this date, you will be having minus 2 months stock prices. Please do understand the future prices, sorry, future prices. For this minus 1 month, for this minus, I mean, you'll not be having any stock price. Maybe this particular contract which is started just now, so you'll be having 1 or 2 days of a price. That's it. Okay, so that's why I'm not going to farer month, or I'm not going to this. I'm going to only this one, 31st December. Okay, so I will just click on this. See, there is a historical price. If I go to this, if I select 3 months, but still that I will get only 2 months data. Okay, 25th September, October, November, and 8th December. So I will take 1 month. That is more than enough. Say, for example, if I take this 25th February, I got it now. Say, if I click on 3 months, how many
చూసి రాసేకి
oh,
ఏం తీసుకురాలేదు మెటీరియల్ కూడా ఏం లేదా
ఎట్లా రాస్తారట ఎగ్జామ్
ఎగ్జామ్ ఎట్లా రాస్తారా ఏదైనా కంప్యూటర్ మెటీరియల్ ఉంటది కదా దాంట్లో ప్రాక్టికల్ క్వశ్చన్స్
రికార్డ్ ఎవరో ఫ్రెండ్స్ ఉంటే
రికార్డ్ ఎవరైనా
సాఫ్ట్ కాపీ ఉంటే వాట్సాప్ పెట్టుకొని చెప్పండి.
అదే ఎవరైనా మనం రికార్డ్ ఏమన్నా ఉంటే ఎవరి దగ్గర
సాఫ్ట్ కాపీ ఉంటే
మెటీరియల్
okay, fine, thank you. Yeah, so you can see here I took 25th Feb expiry contract, but I got, even though that I've selected 3 months, but I got only this number of days. That means it started on 27th of November, you can see. So that's why, like, I will take 31st, or any contract you can take. Just you want to know this per hedge ratio for the only this number of days, you can do it. Or I will take 31st, I will take 1 month. Oh, sorry, I should, okay. Once I select this, you have to click on get data. So this particular price will change. Then you have to go to the historical price. Then you need to select 1 month and get the price. So you got 1 month price from 10th November to 8th of December. Okay, I will take the data. It's not downloading. Okay, I should click on download, right? Here, yes. Okay, I got the price. So we know that I'm gonna take only the close price. So please do remember, it's a future price that I've taken of. I will change here. This is 31st December contract. 31st December 2020. Collect spot price of Nifty index also for 1 month. So first what I did, that I've collected future contract prices for 1 month. This one. Okay, I will write future price. Now I need to collect spot price for the same days. It should not be different. The days should be same. So now I will go to this spot price, right? I will go to products and I will go to indices, not equity. If I go to equity, then it's a stocks that I'm gonna get, indices that I'm gonna get the index. So I'll click on index, you will get historical data. Then for the first one, historical index data. So here Nifty 50 it's selected. You can select anything that you want to, but here Nifty 50 that I've assumed, the days you have to give, it is from 8th December to 10th November. I say it is 10th November to 8th December. November is 11. Okay, I got here. It is November 10, 2020. Here 8th, right? So 8, 12, 20. Yesterday. So I got the spot prices now. These are all the spot price which I got for a month. So click on the data, open. I will take only the close price. This will remain same. So this you can see here, the price is opposite. You should be very careful. The data cleaning is very, very important before going to do any analysis. You should be very careful. It is the 10th, here 8th. So what I do, simply I will select this. I will go to filter. Yeah, filter it. The smallest to oldest to newest. No? Okay. Yeah. See, now price has been changed. 8th December to 10th November. Right? This is correct. No, I think it's supposed to be the opposite. This is correct. It should be like this, because I'm going to calculate the price difference or the return. This is correct. That means the other one that I have to change. I will go here. No. Before that, I will change this. I will apply. Yeah, like this. So now I will copy this particular price. I hope that you people understood what I did here. Okay, so now 10th November future price is this, and 10th November spot price 12,631. You can cross check. 10th November 12,631. Okay, so this data cleaning is very important. I will close this. It's not relevant now. I got this one. So now what I need to calculate here, I should use hedge ratio, right? First I need to do this particular equation. Somewhere I will paste it here. Yeah, this one I need to do. So for Rx I need to calculate. I'll write here. One is standard deviation of X, S, that is spot price, standard deviation of F, future price. Then I want Rx. Rx is nothing but coefficient of correlation. These things, and a hedge ratio. I need to calculate hedge ratio. If I do this, okay. So now for the standard deviation, the equation, the normal equation is, I don't know, like I can write it here or not. It's a square root of summation x divided by n, sorry, summation x square divided by n minus summation x divided by n whole square. That is the equation for standard deviation. But I don't want to do that because I have an Excel. It's very easy to calculate here. So please do understand, summation x square, the x is returns. Okay, so that's why I need to calculate the returns here. I hope you understood that I need to calculate the returns. The standard deviation you can calculate for price, that you will get a different one, but you have to calculate for returns, standard deviation for spot as well as future. So now I'm going to calculate. I cannot calculate the return here for the 10th one because the 9th November price is not there. I will go to the 10th one is equal to, the conventional equation is today's price minus yesterday's price divided by yesterday's price into 100, correct? So what I do, today's price minus yesterday's price, close the bracket, divided by yesterday's price into 100. I will not do, it's okay. So I got the return for the day one. Just double click on this, you're gonna get. One more method is equal to today divided by yesterday minus 1. You can see both you will get the same value. Okay, either you can go with the equation of the conventional way of calculating the returns, today's price minus yesterday's divided by yesterday's price, that is also it's okay, or today divided by yesterday divided by minus 1 also will give the same answer. So anything is okay. The same calculation I will just do here as well. You can see today minus yesterday divided by yesterday, I got the returns. So first and most thing is that you need to calculate the standard deviation of S spot price, right, is equal to STDVP of this. I've selected, simply click OK. So you got some value. Okay, now similarly for future also that you can calculate is equal to STDVP of the value. You can just click on shift and control down arrow, it will select the entire thing. Then you need to use you have to close a bracket, just click on OK, then you will get the standard deviation of future price also. Then coefficient of correlation, if you do it for this price or the returns, it's one and the same. So you can see correlation array 1, anything is okay here, comma array 2. It's not like beta that you have to take always X is a stock return and this one as a future index return. It's not like that. So I got 98.99% correlation. Let's see, like, calculate for the price, correlation for the price. Sorry, comma. So you're gonna get the same value, but here 99.88 only, because that I've taken 10 November also. And still that I'm getting little different answer. Okay. Usually that you should get the same answer, but it's okay. 99.87, but still this is recommended to calculate on returns, because that the equation, if you see, yeah, it is summation xy, right? X is returns of spot and returns of y. So these are all the returns. So it's better to calculate on returns instead, like, the price. Okay, as I'm taking for this compulsory that I have to take the returns, standard deviation of S and F. For this also you have to go ahead with the calculation of the coefficient of correlation on returns only. So I got here. So H star equation is here. So what I do is equal to coefficient of correlation into, or it will not understand if it is bracket, it will not understand as into. You must click on star. Okay, open the bracket, standard deviation of S divided by standard deviation of F. Okay, so 1.04, you need to hedge 1.04 of your portfolio. 1.04 this. Okay, so now I need to calculate N star, how many number of contracts required to hedge. Okay, for this the equation is, I will write here N star. Okay, N star is equal to, is equal to H star, should open a bracket here, into now the question is about the number of contracts, I'm assumed here, you can see, just I wrote here, 1 second, it's not moving. Okay, see what I did here is the calculate the number of future contracts short to hedge for 1500 units. So I've assumed that there is 1500 units in my portfolio, so I need to do that. But here, how many number of units that it's there in each contract, I have to check here. Future, no, future equity derivatives, Nifty. Yeah, index futures Nifty 31st December. Yes, this is what that I've selected. You have to see the lot size. 75 units are there in the each contract, but I want to hedge 1500 units in my portfolio. So here the value will not be explained. That is the disadvantage in the optimal number of future contracts by using the hedge ratio. So that's why the further improvement has been done in the coming models, which that I'm going to discuss. Okay, so that is the disadvantage here in the hedge ratio. The value will be explained further. I will explain that. So now N star is 75, NA is 75, sorry, 1500 units are there in my account. So divided by 75. 75 is the one future contract of index is 75 in the lot. So I need to go for 20 contracts in that case. 21 contract, sorry, 21 contract. Okay. So this is how you can calculate. Yeah, you can calculate. It's star, I did not get it. One second. And N star is, yes sir,
So we
go
can
ahead.
calculate. So we can calculate the value also because we know the value of one lot. So then we can, if we multiply by 21, then we can get the values also. I think so.
Okay, I will tell you the disadvantage in that, sir.
Yeah.
Yeah, 1 second. Okay, see, logically, if I say that I'm assuming that some, if I have only 1 lakh rupees of my portfolio, the value, okay, the market capitalization of my portfolio is 1 lakh, but out of which 1500 units are there. That means whatever the stocks that I'm holding, the price of the stocks is less, but the value unit, say for example, S Bank is 18 rupees now. I'm holding some 1000 shares. How much that I should be having? Say like 18,000 rupees, and another 500. Another 500. If I have say like an Infosys stocks of say some like 20 or 30, or like maybe like 50 in the sense that I should be having some 60,000 rupees. So rest of the other stocks which is having very less in value, okay, maybe DHFL, you can take an example. DHFL again, it is around some 10 to 15 rupees. So even that I have, total it is 1500. The value is only 1 lakh rupee. When you are hedging 1 lakh rupee value of 25%, whatever the percentage I got in the hedge ratio, what I got in the hedge ratio is 1.0. for say like it is 1,05,000 rupees that I want to hedge. For 1,05,000 rupees, you're ending up in paying 21 contracts. What is that 21 contracts? It's not the very less value. 21 into your this one. What is that? This value. Okay. Into your into 15% of that, into 75. So I will just give a clear picture of that. 13,512, okay, into 75 each contract. Such contract I need to do 21 contracts. You meant to say it is 21 lakh 18,000, sorry, it is 2 crores 12 lakh 81,400 rupees value of future contract you need to hedge. 15% of that is, it will come to 31,92,210 rupees. So usually that is illogical of hedging so much value for just
Yes, sir.
1,05,000. Yeah,
Whereas my portfolio is only of 1 lakh.
yeah. So just I'm giving an example.
Yes, sir. Yes, sir.
For 1,05,000 worth of portfolio, you are ending up by paying 31,92,000, which is a 15% of your full portfolio of 21 contracts, is illogical. That is the disadvantage of this particular hedge ratio. Okay, so there are models which is developed where you can overcome that. That I'm going to explain in the coming session. Oh, it's too early. Okay, anyway, so here just I wrote, this is the answer that I got in number of contract short to hedge. So I cannot write 20 here because I don't get 0.88 contract, right? So that's why I made it 21 contracts. I need to take short position in 21 contracts to hedge my portfolio. But somebody who is having a portfolio of say like 50 crore, yes, it looks fine. Somebody is having 5 crores of portfolio, it looks fine. But somebody is having 1 lakh, 2 lakh, 3 lakh, or say even 50 lakh rupees. You are hedging with 31 lakh. I mean, you are paying 31 lakh with the value of 2 crores. That is not recommended. So it will not apply. This particular model will not apply for such smaller portfolios. That is what I meant. That will be overcome in the coming models which that I'm going to discuss, or how you can take an advantage of this. I think I need to finish by 12:45. If the coordinators gives a permission to go ahead, I will touch upon the last part of the commodity futures, so that afternoon session I can finish little early. Sir, is it fine, or you want me to break now itself? Sir or madam, Saranya ma'am? I think they are offline. Anybody, any coordinators who are there? Okay, no coordinators. Fine.
In the meanwhile, I can ask a question, sir.
Yes, sir. Go ahead, please.
Because I am asking a lot of questions, sir, because I have a doubt.
Actually,
Sir,
participants ask questions, then I should also start thinking. Yeah.
Sir, it is that you have written calculate the number of future short to hedge.
Yes.
So my query is, how do you find out this short?
Okay.
That is your intuition or that is your market prediction? Because short is it can be long hedge also.
Yeah, it can be.
It can be. Hedge ratio will be telling me what is the percentage that we have to do for that. My only query is how to find out whether it is long hedge or whether it is short hedge. So,
Okay.
any
Sir,
suggestion
here,
on that, sir?
yeah. So
Yes, sir.
here I said I'm holding a portfolio of 1 lakh rupees. That means that
Yes,
I've purchased of stocks which is a worth of
yes,
1 lakh, which is having 1,500 units. That is what my assumption here. That
yes, sir.
means already there in my portfolio, I fear that the prices will fall.
Okay.
So when I
Okay.
fear that the prices is fall, then I have to take a opposite position
Short position
of shorting such kind of a portfolio. If you
portfolio.
short the portfolio, you can offset the losses which you are going to incur, whatever it is there, or whatever that the losses that you are going to incur in the existing portfolio.
Yes, sir. Got
Yeah,
it.
so in that case, you can go for a short position. But
Okay.
when you have purchased the portfolio, if you think that the price is going to increase, I don't think so hedging is required there. You'll be very
Then
happy.
very happy. Then it will
Yeah, in
go
that
like
case,
that only.
there is no need of hedging at all. The
Yes,
long
yes, sir.
hedging is going to come when you are taking a short position in the future without holding anything. Okay, think that you don't have any portfolio. Simply that you got into the future contract where you want to trade it, you know that the prices is going to fall, so you have taken a short position.
And
But
to
for
hedge
your
that, then
bad,
you have to take a long.
yes, for your
Exactly.
bad, because of some reasons, okay, positive news, maybe like, instead of Trump, Joe Biden have elected. It's a very good
Exactly.
news as per
Yes,
Indian
sir.
expectation.
Yes,
So
sir. Yes, sir.
because like people who are working in US, they are gonna get visa. So these days, like people who are there in US, they are stuck there. If they come here, they cannot go back until that particular
Exactly.
restriction is going to be lifted. So that is a very good news for India. So the market has been increasing.
Yes, sir.
If the market is increasing, you have taken a short position, then you have to take a
Then
long in another contract to offset the loss.
exactly. So
Yes.
in nutshell, when you want to hedge your short position, then you take a long hedge.
True. Yes.
Exactly. Okay. Thank you very much, sir.
Yeah. Yes. Any more questions, please?
Sir, which book do we refer to get these problems or solve and learn more about derivatives so that we can teach PG students and UG students?
Yeah. Ma'am, I do really don't recommend any book, but the theory that
Okay.
you want to understand is Vora and Bagri in Indian context is good. But again, Vora and Bagri, F&O, that is futures and option. The title is futures and
Okay.
option. Vora and Bagri. ND Vora and Bagri, that is what the authors.
Huh.
But the problem in the textbook is outdated. It is not revised.
Huh.
Means if you
Okay,
see the
sir.
index, for example, that I took the index here, I chose 13,000 something as per
Yeah.
yesterday's closing price. But those guys are
Okay.
using the index of 2009 of 2000, 1200, which will not
Okay.
give us
Okay.
actual component when it comes to numerical.
Yeah.
But theoretically, it's a very good book.
Okay, sir.
Sir,
So
can you
we
write?
can frame our own problems from these websites, no, sir? That is how you are framing. Like that only we can also frame, no, sir?
Yes, yes, yes.
You
Okay.
please write
Right.
that
Sir,
name of
if you
author
could.
in chat box. Okay,
I
Yeah,
wrote
got
it.
it.
I typed in the chat box. I
ND
typed it
Vora
actually.
and Bagri. I think I have a scanned copy. I asked my student to send it. My book is there with the student. They did not return back. So I think if I
Okay.
have, then I will forward it. It's there in the drive, I think.
Oh, so
It is
nice
there
of you, sir.
somewhere. It is there. I will be forwarding scanned copy. I don't think so that will give. I mean, I should not be forwarding that as per the copyrights because you need to buy a new book. Maybe I will. There is
Can
no.
share it along with the PPTs.
Yeah, I will do that, ma'am.
Okay, sir.
And if somebody is already uh, uh, like good this book, you can see it's still in second edition. When
Oh,
I was there in 2009, when I was referring this book, then even now it is there in the same edition. It is not updated. That is the
okay.
problem with this book. But the conceptually it's very good, where it's in the Indian context. But the numerical, you can take that particular example and you can revise the data. Say, for example, I
Okay.
should not show this. I will just show the recent question paper that I gave to my students. Anyway, that the exam is got over, no problem. Yeah. So in semester, this is the question paper that I got. I prepared for them, but all the question, whatever that I prepared with the existing data. So like that, you can do it or take the data online and do the analysis. They also will be very happy. All this data, see all this data which that I've created for on existing data. All these like I took all these securities and the prices have changed. But the same question is even is there in the textbook. But the company securities they would have given ABCD and some price, number of shares they would have given. But all these things you have to create it. like that I've changed
Okay.
here. We have 1200 as an index and these things. So like that you can create it and give to students. That would be helpful. And when we do like this, and it will reduce a lot of efforts from us, say like standing and teaching is not there, where you can sit in front of the laptop and project it and teach the students. They also will enjoy.
Yes.
Like this, you can see. Any more questions from anybody? It is
Sir, could
12:30.
you, if there is time, could you please show one example where what prices like we can take from websites? If you could please demonstrate one small example, sir.
That's right. See, in NSE right now, no? So
Yeah,
in
how to
NSE,
understand the website?
yeah. See, as soon as that you open the website, the NSE, the newer version of NSE website will be open. Okay, here also you're going to get all the data which is there in a market data, and in market data you will go. But I'm not comfortable by using this, so I will go to the previous version. I clicking on that. It will be easier. You can go to product. If you go to live market, all the data which is happening right now will be seen here. But
Okay.
historical data you want, it's a daily data only you will get. So equity, any stock prices of a company that you want to find, you can go with this. Indices is the index. Just now I told bank or Nifty 50,
Yes.
you can get it like this. All the derivatives, which is on equity, commodity, currency, interest rate, will get it here. So these are all the data, historical data only. Say like, if you say like you want only IPO, you can go for this. ETFs, you can go for this, mutual funds. So like that, all the data, daily data you will get. Say equity I have selected, historical data I will go, security wise, price volume, if I click on that, any company data you want, you can collect it here. From
Okay.
2009, you can collect it, but maximum of 24 months. Say like, for
Months.
example, Infosys I want, Infi, that is the symbol. So I will select EQ here and I will select 24 months, or you can also specify, but when you specify it, it should not be more than 365 days. But it is month you are selecting, you can select 24 months and go ahead of clicking on data. You will get 24-month data. You can download. Again, depending upon your research problem, these factors can be used. Usually, the close price will be used. Some people like your objective is on the last 30 minutes of trading, then you can go for this weighted average price. Then, or like, your objective is on the total traded quantity, you can go ahead, trade a turnover, number of trades. All these things can be taken depending upon your objective. This is one, and one more is indices. Indices also you can go here, then data, and here historical index data. So you will get all the index which is listed, either sectorial you want, next Nifty next, or mid cap, or 100, 200, anything you want, you can collect it here. Sectorial indices you want, you can also go ahead. There is a lot of research also is done on this, like auto, bank. Say for example, auto, that I'm going to choose from, okay, 9 to 10. 11, okay. So I will get the data for auto. Index, this is index. So like that, even currency also you can do. I'm not teaching currency. So currency also you can collect it the same way. Here, these are all the day-wise turnover or achieve or anything, daily report view. These things you can collect it. I'm not that good in currency, so I do not have idea. Usually that I'll be going with equity only. Interest rate futures also. This usually is for banks. Interest rate futures, it's for banks.
Yeah.
The traders is not allowed to do this. Only the for it will be happening with the LIBOR and LIBID, that is London Interbank Offer Rate and Buying Rate. So swaps, all these things will be happening only for the
Banks.
regulated banks. Yes. So like that, you can explore this data, but daily data you will get. But these days, as the models are developing, say like the artificial neural network or any other models, advanced models, they are looking for a tick by tick data. That means second by second. So if such kind of data is required, then of course that you should be having access to the database, say like Bloomberg or Thomson Reuters. Even in Provis, it is not there. Provis also it is not there. In our university, we have Provis, which is very good for a company data. I mean financial data. Like if you want tick by tick Bloomberg, I think by January they are subscribing in our university. Tick by tick data also can be.
Okay.
Any other questions, please?
Thank you very much, sir.
Yeah, that's welcome. Okay, so I'm writing my details in the chat box. I'm also there for the third session. Yeah. So in third session also that. Yeah, I'll be sharing anyway. I'll be sharing my details in the third session that is there in the text. So, yeah, session 3 I have, and it takes a lot of time. So that's why I thought of like, just throwing a light on this. It's not in the scope of today's discussion, but still like same way, like we did commodity futures here, the underlying asset will be commodity, that's it. But it's a standardized legal contract. The standardized because this is through the stock exchange, that is MCX. NSE has been started from December 1st. Then there are two methods. One is carrying commodity and one more is non-carrying. When it comes to carrying commodity, it's only for investment purpose. Okay. So when it is for investment purpose, such commodity should be stored somewhere, right? In some of the the godown. So they'll be charged for that, the storage cost. So you can use the equation S0 plus S e to the power of RT, but this S is present value of the storage cost you have to calculate. When they're given a per unit, then yes, you can go ahead with this. But there is a possibility of giving a proportion of spot price, percentage of a spot price. In that case, you have to go with this particular equation. Similarly, for non-carrying, this is for consumption, maybe like agricultural products like oil, soybean, or whatever that I was telling before the example. So for that, you can use this particular equation, the model which is available in non-carrying commodity. That is, again, it is a storage cost, but there is something which is called as new addition is conveyance. That means transportation cost, carrying or transportation cost, because this is for consumption, right? So if it is consumption, they have to deliver that to the trader, or I can say that to the purchaser. So when they purchase, the transportation charges also will be charged. That also to be included here. Okay. If this storage cost is given per unit, you're going to use this. If it is for proportion of your spot price, then you're going to use this particular equation. That's it. There is a lot of research on this as well, the commodity futures. So maybe like, the implementation of December 1st, that's commodity futures in NSE, how it is beneficial. Maybe an event study can be done because it's the latest news. So you people can do a research on that as well. Either it is impacting adversely or favorably to the NSE, that also can be done. Of course, it will be positive, it's a known fact, but that you can show that through some tools, some event study tools, you can do it and do. Maybe like eGarch, you can use exponential Garch model and you can do the analysis for that. As it is a newer topic, or I can say it's a current topic, so the acceptance of such particular paper will be huge, but it takes 1 month to prepare. So by then, a lot of research also can be done on this. So usually that I'll be doing a research on index or volatility spillover. So that's that's very less example that I quoted on the stock prices, but all other things it's on index only. Usually that I'll be doing on options, not on futures. So, but still, like the options is like I can say that practical, when it comes to practically, there is a lot of mismatch between the model which is developed in the Black and Scholes model, or like whatever the hedging strategies are there to the practical now. So such mismatches to overcome is very difficult. Okay, so that's it from my end before lunch. So any questions you can ask me. If not, I will request coordinators to take a decision of going for lunch.
Yeah,
Sir, like in
Sir,
hello.
so what kind of research or for PhD is being done on derivatives, sir?
Uh,
Currently,
million
like
dollar question, madam. Because see, usually when it comes to problems like that, to do a PhD, it should come from within, and they have to do a literature a lot. Maybe like 200,
okay.
300 article literature, that if they do it, then
Hmm.
I assure that like by then, clear picture of what you can do, what is the research gap you can find out and do it.
Hmm.
But
Hmm.
by using techniques say like Garch DCC model, so there is a lot of
Hmm.
research can be done. The stock volatility spillover. So just I will check
Okay.
DCC model, DCC Garch. Okay, so that is multivariate Garch, where you will be having a multivariate models. I mean, independent variables in your model. And you can use it.
Hmm.
It's not that easy, it's really complicated. That is dynamic conditional
Okay.
correlation. So these things, see, as in PhD, as that you'll be making complicated analysis.
Yeah.
If in a panel, if there is no like
Hmm.
panelists who have a good idea about that, then like
Yeah.
always we can escape. But 100% that the panelist who is going to come, they'll be very strong in statistics.
Hmm.
So
Hmm.
when you are doing the analysis and when you are presenting it, the results we have to present it 100%. They may not
Hmm.
ask like
Hmm.
why you took this particular variable, why you took this technique and doing it, but what result have you got? If you are able
Hmm.
to
Hmm.
justify that with the 100% confident, I think we'll not be having any
Hmm.
problem. That's what I guess.
Oh, okay. Okay.
Most
Right.
of the universities, as I have seen, like using this econometrics model. But the
Huh.
PhD is less. I think Pondicherry University is the one they have started from long time, and they are doing a lot of. I mean, even the students also doing. I mean, research scholars also doing a lot of PhDs on this. Apart from that,
Okay.
maybe it is there in IIMs and IITs. I mean, their level is different.
Hmm.
So any
Hmm.
other state universities, if you say, then I don't think so. They have reached to that particular extent, but still they are there in some profitability analysis and that particular stage. I'm not degrading
Okay.
any of the university, but just I'm telling you the fact
Yeah.
that as with my experience, the model are also not question much about that.
Yes. Yes. Yes.
Yes, madam. That's it from my end. Yes,
Okay.
Saranya,
Okay.
madam.
Right.
What we do now?
Thank you, sir. Thank you so much.
Sir, last
Sir,
question. So can
sir,
how can we get
Yeah.
in like in
Yes, ma'am. Yes,
commodity derivative? You have told us to get a spot price of equity in NSE. So can we get an cost to carry price, matlab storage cost and other cost which is the website from where that we can get that cost so that we can calculate the
MCX
commodity
website.
future?
MCX.
Yeah.
MCX is,
MCX.
see, cost of carry. You can see here the cost of
Okay.
carry. You can also get cost of carry for this
Okay.
particular buy and sell price. What is the cost of carry costs? You will get it here. And also
Okay.
MCX is a right
Platform for
this
commodity
one.
derivative.
Yeah. And see, instead of going into these websites, which is developed by the stock exchanges, but if you have a database, it's very easy to get. In a click of a button, you're gonna get all the companies, whatever that you want, just you have to click and submit it. Then you will get the data. But here, this is a little complicated. It's going to give whatever it is necessary for this particular page. That's it. See that I have selected here Nifty 50. They are given the cost of carry like that.
Softwares are, sir, very expensive, and
Yeah, it is
college
expensive.
very expensive, and the university, very few university are taking the subscription
Yes.
of that.
Yeah.
So that
Actually,
is
like in our university also, they asked all the teachers like, is it required this one Bloomberg? Then everyone said yes. So okay, this is the cost, 60 lakhs or something. Or
exactly.
yeah. So that's what they said is, oh, I mean, we can't do anything. They said okay, fine, they will
Yeah.
get it. But without
Actually, sir,
having a database, database like that, and if they are
very
asking us to
difficult to do that.
do research, then output will not be that good.
Exactly. Exactly.
Yeah.
So that is
Yes.
an irony of Indian university. They talk of the research, but they provide very less resources.
Yeah, that is there. That is there. We have to cope, sir.
Yeah.
Yes, ma'am. I think one faculty or teacher was asking a
Yes, sir. Sir, actually, I wanted to know the exact reason, why individual investors are hesitant to trade in derivatives. There is still that hesitation or a kind of this thing where a mental block where people, as I've spoken to many people, when it comes to various investment alternatives, they are really not either they do not have the knowledge or they are not interested.
Yeah.
Am I right,
Okay.
sir? Why is
Yes,
it so?
yes.
What?
Yeah, that's true. Even I'm one of the kind who's there in that particular category. The reason behind very simple. Our commitments are different from the any other country people, because their commitment is like they will work for 6 months and make money, how much ever it is, and go for a leisure. Our commitment is not like that. We will think about like 3 to 4 generation forward. And our the thinking
Okay.
like we have to save something. We should not take risk. If we take risk, then whatever that we earn here we may lose. So this kind of mentality that when we have, then it's very difficult. See in US, if you see, like they'll be working for 6 to 8 months and they will take the salary and they will go for a world tour and enjoy, come back with the no money, and again start working. Their mentality is like that. I'm not telling everyone, just taking an example or some sample. But
Okay.
Indians are not like that. Indians are very conservative. They think like we have to save. Even if you
Yes,
ask me like yeah, I have to save for my daughter, my family, then it is like that. Their thinking is like that. So if such kind of mentality we have, then surely that we don't take risk of trading. And again, one more thing, time is very important. See, the time what we have, it's everything is killed by the university. Full work, whatever is possible, they will give full work. And especially during this COVID, even at night, if you work, the work is not getting over. So if that kind of a pressure that we have, then it's very difficult to concentrate on trading. Trading that we require sufficient time and the knowledge and the mentality. Even if you lose it, okay, fine, let it go. If you have such mentality, then of course everyone will be interested, and it is very difficult to have such mentality in India.
Sir, it
I'm
is
not
not
telling
only
you.
that. As I have seen, it is like, some of my friends who are trading in crude oil or maybe in gold, it has never happened that, they have always made profit as such.
Yeah.
Though it is called as a hedging tool, sir, I see that, you know, there is lot of risk in terms of price volatility, where people are always under, you know, tremendous stress on, you know, the changes in the price in the market. And some people that I have interacted, they tell that, you know, it is absolutely unpredictable. Especially the crude oil price and all that. I mean, I'm not trading as such. I do not have hands-on experience on that. But this, after hearing to such people, it really makes me wonder, like, you know, should I really, I want to be cautious, should I really get into this trading is what I think.
Yes, yes. No, like Prabhakaran sir is also telling, it's absolutely right. It's a risk management tool, but also there is a lot of scope of making profits as well. That's why our mentality, if we are a hedgers, then we will be hedging. But if you think about speculating it, we can do that. But the risk is high. So it depends upon, like, you know, risk taking capacity of an individual. If you would like to take a risk when we do not have any commitments in other side, then yes, of course. So our Indians is like, you know, we'll make a pre-commitments by having a credit card or EMIs and so on. So we may fear that if I lose here, then what do I do for these commitments? So these also can be one mentality where they will not get into, they fear to get into these future contracts trading. They also can take a benefit of earning from these derivatives. Yeah. Shall we break now, ma'am, for lunch?
Yes, if there are no questions, we'll definitely we can break for lunch, and we shall meet again by 1:30, sir.
1:30. Yes, yes, ma'am.
Post-lunch
That's
session shall
fine.
commence at
Yeah, if
1:30.
any questions are there that I'll be taking in the afternoon. I thought of
Okay.
finishing early because even I have exam duty in the afternoon. So I requested my colleague to do it up to 3 o'clock. So
Okay.
I hope that it will be finishing by 3.
Yes, we'll start by 1:30, sir. Definitely we'll get over by 3.
Yes, 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 madam. Thank you so much. Thank you. Thank you,
Thank you.
everyone. We'll join back at 1:30. Yeah, we have very less time. Yes.
Dear participants, the post-lunch session will commence by 1:30.